How do you choose the best decision support system, or DSS, to trade the stock market? Why do you even need one in the first place? Well, if you don't have a DSS to trade the stock market, you're flying blind and are making mostly impulsive, on-the-fly decisions based on noise and other random, out-of-the-blue variables. Doing this will get you, or more precisely, your profits killed in the long run. Eventually, and probably sooner rather than later, the market will do something where you just won't know what to do. You'll be stunned into indecision and inaction. And the eventual on-the-fly gut feel decision you make there and then will turn out to be a huge mistake, a potentially irrecoverable error. Look, if you want to become a consistently profitable investor, you must have a well-defined process for making all your investment decisions, and in a timely, confident manner. Not any old system will do the trick, of course. In fact, some of the most popular DSSs will actively work against you. And yes, there are countless DSSs to choose from in the investing space, but they can all essentially be grouped into three types. Firstly, a subjective DSS. Secondly, a mechanical DSS. And thirdly, an intuitive DSS, in this specific order. Because this is the typical path of a wily, street-smart, highly experienced and successful trader. But you need never get to the DSS Type 3 stage to be very successful in the financial markets. In this brief video, I'll quickly introduce you to each of these three types of DSS, or decision support system. You can explore more written details about each type in my written blog, or even more detail in my ebook, 15% per year in 15 minutes per week, where you can get further help to decide which type to use based on your current investing skills and situation. The links for both are provided below in the description. Okay, let's dig into it, starting with DSS Type 1, a subjective decision support system. If we were to cling to formal definitions, a DSS can't be subjective. That's because, by dictionary definition, it's a quote-unquote computerized program or engine used to support determinations, judgments, and courses of action for an organization or business. There's no computer or engine when using a subjective DSS, because a computer needs unambiguous instructions. Even AI does. Computers can't compute subjective instructions. You know, garbage in, garbage out. Heck, you don't even have a DSS going by the dictionary definition. Instead, you are the DSS. The same applies to DSS Type 3, an intuitive decision support system, which is basically a subjective DSS on steroids. With a subjective DSS, the trader is cognitively trial and erroring their way through the quagmire of ever-changing market variables. Whereas in the case of an intuitive DSS, you have a wealth of experience and investing skills under your belt from years of trading, and aren't constantly changing the basis for your decisions. In other words, you invest with your subconscious instead of your cognitive mind. Your intuition and street smarts are computing all the variables in the investing landscape to decide what and when to buy and sell and what not to buy. Many investors mistakenly believe they are using an intuitive DSS when in fact they are using a subjective DSS. Look, you can't just wish this sort of transition into existence. It takes decades of experience, trial and error, winning and losing, and slowly in a time-grown manner, honing your stock market gut feel and intuition to make it to the third level. Even the few investors who get to a Type 3 level of DSS used a Type 2 DSS, a mechanical DSS, as a stepping stone, and then intertwine it with their cultivated experience. Over time, their subconscious mind syncs with the market at a similar enough wavelength to be consistent and objective. They develop a peripheral sense and vision to be able to see, feel, and hear the market. Sounds amazing, but as I've said, it takes decades of hard work and financial and emotional loss to get there. Hence, nary a tiny few investors actually reach the level of executing with an intuitive DSS. I dare say, I've witnessed said DSSs kill way too many investors' profits and emotional well-being, either with DSS Type 1 or fooling themselves they've reached a DSS Type 3 level. Using all kinds of subjective analyses techniques, the great majority of stock market investors use a subjective DSS, which is, in my opinion, why most investors fail to become consistently profitable. You simply can't achieve consistency with a haphazard approach, at least not without suffering through many formative years of losses and emotional turbulence first. Which brings me to a Type 2 DSS, a mechanical decision support system. If you've read any of my articles or watched my other YouTube videos, you know I'm all for having a mechanical investing system that uses a clear-cut on-off algorithm with rules and criteria you follow without fail. You can't call this a bias because it's based on facts and hard-nosed evidence. Look, a mechanical system's very purpose and design blueprint is to destroy biases, and ever since the 1980s, experienced traders have used it for just that, to overcome personal baggage, emotions, innate human heuristics, and external opinions with their buying and selling decisions. When you make investment decisions using a mechanical DSS, you have a carved-in-stone, rules-based system. These well-defined and unambiguous rules are 100% objective. In fact, there's just one input to this type of DSS: price action. What, when, and how much to buy and when to sell are all computed by the DSS in accordance with pre-researched and defined rules applied to the price action data. By definition, this makes the mechanical DSS a consistent, objective, structured, unemotional, and organized way to invest. There are no guarantees of success, of course, but unlike with a subjective DSS, you know the probability of success in advance. The probability is defined by the researching of historical price action until you have a good enough edge and is therefore known from the get-go of your trading. Another cool thing about a mechanical DSS is you can start using it instantly without years of trial and error live trading and gaining market knowledge. That's because said knowledge is ingrained into the DSS. More specifically, it's learned through research and backtesting, which is then programmed into the DSS. It's this knowledge that allows you to synchronize with the market. It won't be a perfect sync, sure, but its profits will be often enough and big enough to lay the groundwork for consistent and sustained success. All you need to do is add the necessary skills to follow the rules to execute the trades, and long-term profitability will come. Now, which type of DSS should you use? If you've listened to this video carefully or others that I've published, it's clear I'm in the mechanical DSS camp and would recommend it to anyone despite their investing skills or stage in their investing journey, at least for some of their investable capital. It's not just me who would make such a recommendation, of course. People like Ray Dalio, Mark Douglas, Curtis Faith, Joe Kritzinger, and nearly all the turtle traders have been advocating for mechanical investing for years and decades. You see, you can't pre-research and backtest subjectivity or intuition. There's no way to state with 100% certainty what your subjectivity or intuition would have decided to do 10 years ago. Consequently, you can only future test to discover if your subjectivity or intuition have an edge over many future real-time trial and error decision-making buy and sell events. This would take many years and you putting real money on the line without knowing your probability of success. On the other hand, you can, with the right knowledge, easily backtest and pre-research historical stock price data and use the findings to create a mechanical DSS with an edge that puts probability on your side. Then, if you want, you can become a successful intuitive investor down the line, but the first step should always be a mechanical decision support system. Still, no matter what I or any other experts say, at the end of the day, most people will continue using their subjective DSS. You see, people's egos and pride get in the way, which makes them highly uncoachable. That's just how things are. But if you aren't one of those people and see the common sense in using a mechanical DSS backed by a verified and pre-researched edge as your best bet for outperforming the market and reaching your long-term financial goals, but have no idea how to develop or find a reliable mechanical DSS to use, nor how to build a mindset to actually execute such a DSS, you can peruse my written blogs at the link in the description below, get my ebook at the link below, or subscribe to this YouTube channel. Remember to click the bell to get notifications of newly published videos. As always, I wish you consistent and objective investing.